professional designations. He holds a doctor in business administration. So we've heard of an MBA. This is a step above. He is also a counselor of real estate. So I read that in order to earn this designation, you have to be invited by your peers into the membership. And of course, once you accept the invitation, you have to fulfill the extensive requirements of the organization. He is also a member of the Royal Institute of Charter Surveyors, or RICS. So RICS is a global professional organization that establishes and enforces standards for valuing, operating, and developing assorted types of real estate and property. Early in my career, I worked in an office with several chartered surveyors, and I came to learn that the academic and professional work required to earn a designation is quite rigorous. Dr. Souza also holds the CCIM designation. Now, CCIM stands for Certified Commercial Investment Member, which is a designation provided by the National Association of Realtors after the completion of a rigorous academic curriculum, the provision of a portfolio of work, and the passing of a comprehensive exam. Our very own Justin Wong is a CCIM candidate and a CCIM scholarship winner. Professionally, Dr. Souza serves as Managing Director for Institutional Investment Sales, Finance, and Research with Brookwood Starboard Commercial. I'm familiar with the gentleman at Starboard Commercial since I leased them their first office space when they started the company. Dr. Souza is also Vice President of Business Development and a commercial associate broker with Searchlight Lending, a commercial and residential mortgage brokerage based out of Marin County. He is also the Chief Science Officer and Economist with CapitalBrain.co. I have to look him up. So Capital Brain is a pioneer in the artificial intelligence / machine learning space for the U.S. commercial real estate industry. So very impressive there. And lastly, Dr. Souza is an adjunct professor of finance at the University of San Francisco, as well as the St. Mary's College of California School of Economics and Business. So with that, I will hand the floor over to Dr. Souza. Dr. Souza, take it away.
Many different hats.
Thanks, Eric. I really appreciate that. Yeah, a lot of hard work over the last 30 years, but it was all worth it. And the network that I've been able to tap into has just been incredible, and the friendships have been totally worth it. Thank you, Justin and Eric, and everybody area. I've spoken with you guys before. Love everybody I've met, and thank you again for the opportunity and the support. I appreciate it. I'm going to go through the presentation very quickly. So if you could hold off on your questions, I'd appreciate it. I'm going to try to get through as much material as possible over the last 40 minutes, and I can do it. So I'm going to hit on some key points in the presentation. I'm more than happy to provide you with the presentation. I think Justin already sent you the PDF. That's basically the deck. And then I think, are you guys recording this too, so you could provide them with the recordation?
That is correct.
Okay, perfect, awesome. Well, I look at commercial real estate and really investing in general, like big wave surfing. This is a picture that I took of one of the contestants in the 2010 Maverick Surf Contest. I used to surf waves like this. It takes constant training, it takes focus, education, study. Big waves come through, you can get totally wiped out, but just like in real estate, if you're smart and you study and you're careful, you can place yourself to ride these things. And if you get taken out, you just get back on your board and you paddle out and you do it again. And you do it over and over again. So the real estate cycle is very similar to big wave surfing. Again, you got to be constantly training, you got to be focused, and you got to be fit in your approach. I'm not gonna make any comments today. I'm not making any investment recommendations. I'm not making any legal or accounting recommendation or giving any advice. If you need any of that advice, either from a real estate professional, a tax professional, an accountant, or a lawyer, please seek out professional advice from a licensed individual. If you need referrals, I'm more than happy to give you 3 referrals and you can figure out who you want to work with. But I'm not giving any investment, accounting, or legal advice today. And my cat Zachary told me to say hi to you guys before we start. Efficient real estate and security capital markets require strong public and private sector cooperation, disclosure of government and corporate financial conditions, and institutional individual investor confidence in both the financial and political institutions. And we've seen what this has happened over the last 4 years and 40 years in particular. The financial crisis was a man-made problem. COVID, yes, I wouldn't say it was a man-made problem, but it was an issue with bad policy and bad administration that allowed the pandemic to basically spread across the globe. We've seen administrations, we've seen presidency, we've seen compositions of Congress, we've seen governments in other countries that have lost their legitimacy, transparency, and all of that affects real estate and real estate valuations. So this is the hypothesis that I use if I'm going to invest overseas. Does the country have good public-private cooperation? Is there transparency in financial and policy? And does the fiscal policies and the monetary policies actually promote economic growth and enforce private property rights through the legal system? What we saw through the pandemic was basically a massive market failure in healthcare. We've seen market failures in racial cultural institutions. We've seen market failures in the economy. We've seen market failures in trade relations between Canada and China. These are all basically failures of government. Those failures need to be addressed to basically realign political institutions and bureaucracies to basically promote public goods and private good provisions to the majority of the populations within these countries to be able to allow for a more equitable distribution of wealth to bring up everybody to higher states of social welfare and standards of living. What we also saw this last political cycle, which we thought was going to be a divided government if the Senate was under control of the Republican Party, but slight majorities of the Democratic Party took control of both the House and the Senate and the executive branch. Based on my research, and I'm writing a book right now with my students, and it's in publication. It's basically on the history of US housing policy, politics, and economics. And one of the major takeaways from the book that we learned going back over 80 years of looking at housing policy was there was a high probability of housing policy and other social welfare policies such as education and housing and healthcare being passed when the executive branch, the Senate, and the House were controlled by the Democratic Party. And you can go back and look at the statistics, and I'll provide you with the book when I get it. But it's very interesting to see that there's institutional knowledge by a certain policy party politic. That means that under control, even though it's minority control of the House and the Senate and the executive branch under the Biden administration, there's very high policy probability of housing policy and infrastructure, which in my view are two of the highest priorities currently at the political level. So having a united government under the Democratic Party increases policy probabilities for housing and for infrastructure, which is good. Under a divided government, when you have the Senate controlled by the Republican Party and you got the executive and the House controlled by the Democrats, that's a divided government, very low probability of social welfare policies being enacted. So I'll let you, read the book and read the outcome here. But I thought that was very interesting. We've seen from the Federal Reserve, both in the financial crisis and in the last COVID crisis, massive over accommodation. The Federal Reserve printed $3 trillion in less than a year and bought up the majority of the fiscal debt that was issued on the fiscal policy side. The fiscal policy side was another $3 trillion. So within a year, we've seen over $6 trillion get pumped into the system, which saved the system from collapsing into a depression. So the policymakers, both on the fiscal and the monetary policy side, I believe were correct policy responses that basically mitigated the significant damage that could have been done to the economy. However, the problem is how do we pay back the multi-trillions of dollars that have been accumulated, not over the last year, but over the last 20 years? Who is going to pay for all of that? And what are the burdens going to be? You're going to be looking at higher inflation, and you're going to be looking at higher taxes. And we may be able to get through this as boomers, shall we say, be able to get through this. But I'm really concerned about Gen X and Gen Y and Gen Z and the next generations that will come, because they're the ones who are going to be having to deal with inflation and high debt and high taxes. So I'm very concerned about my grandkids and my great-great-grandkids and my great-grandkids. It looks like we're going to be growing at about 7 to 8% GDP in the second half of this year, which is extremely high, although it was revised down from 10%. This is historical growth rates that we have not seen since post-World War II. It could be inflationary, although the inflationary trades look to be coming off their peaks. I think there's more concern in the marketplace because you've seen the 10-year Treasury start to come down, that the economy may be slowing, but I think the Fed will still continue to pump money into the system, will still continue to accommodate, keep the yield curve low, keep the 10-year Treasury down, which basically actually bodes well for us over the next 24 months. My biggest concern is if inflation expectations decouple and de-anchor from their low level currently, that we could see short-term interest rates rise and spike fairly rapidly over the next 12 to 14 months. If the yield curve flattens and inverts, based on my research, the stock market will peak in 12 months and will be in a recession in 24 months. So if the inflation continues to move through the system at a very high level, which is where it is now, that drives short-term interest rates up and flattens the curve. And if the curve actually inverts where short-term interest rates are higher than long-term interest rates, based off of my research, the stock market peaks within 12 months and we're in a recession within 24. So if the curve inverts at the end of this year, or let's say at the beginning of next year, 2022, the stock market will peak in 23 and we could be in a recession in 24. That's your worst case scenario, okay? But the Fed will be there to respond. But the Fed's kind of running out of bullets because its balance sheet's around 8-9 trillion. And the fiscal policy side of the equation also is running into some fiscal policy constraints because we have massive deficits and we have massive amounts of debt. And at some point in time, the Federal Reserve will not be able to stomach continuing to basically support fiscal budget deficits basically generated by Congress on a perpetual basis. Once the Federal Reserve starts to become an arm of the Treasury, based on history and a comparative standpoint looking globally, it leads to hyperinflation, which then devalues the currency. And then you start to see a major deterioration in social welfare and standards of living. And then here's a graph that just shows, I broke up the decades since 1940 in 10-year and 5-year increments. And you can see that the majority of the recessions occur in the first 5 years of every single decade. It was 1958 and 2008 were the only recessions that occurred in the last 5 years of the decade based off of this analysis. So there's a 90% probability of a recession in the first 5 years of every decade. We're in a recession or coming out of a recession right now, so the theory still holds. There's a 70% probability we'll be in growth peak phase of the business cycle in the last 5 years of every single decade. That becomes your tactical and your strategic investment strategy if you believe in this business cycle theory. Political economics. What I found out by having multiple degrees across multiple disciplines is we as real estate professionals need to be not necessarily experts, but we have to understand the financial and managerial accounting. We have to understand finance and capital markets. We have to understand economics, both fiscal policy and monetary policy. We have to understand politics because that leads to policy that then becomes law, that then becomes administered through the bureaucracy, that then creates intended and unintended policy outcomes and positive and negative externalities. And I challenge you guys to elevate yourself. I think most of you are experts in accounting, finance, and economics, but we really need to be thinking more from a political scientific standpoint. Look at policy and party compositions and try to forecast where we think policy formation will come, what those policies will be, when will they be enacted, and who will be hurt and who will benefit from those policy outcomes, and either leverage those policy outcomes based on the economic segments or the demographic segmentations that will benefit or get hurt from those policies. And if you're going to get hurt by the policies, you need to have contingency plans in place to be able to mitigate the damage associated with those policy outcomes. So we need to be a little bit more sophisticated in our approaches, not only to real estate investing, but also to advising for our clients. What I also found out over the decades is that the financial crises and the COVID crises create and set off what are called these dialectics that basically rearrange their massive global shocks to the system that creates basically realignments in institutional arrangements, excuse me, between governments and their citizens, corporations and governments, and corporations and their consumers and their clients. So the financial crisis set off a dialectic. Then we had basically the Trump administration set off another dialectic, the Biden administration setting off another dialectic, and COVID setting off another dialectic. So we basically have had 4 dialectics in the last 12 years that are setting off these rearrangements. And historically, based on my research, these dialectics usually occur every 30 years, not 4 in 12 years, but 1 in 30 years. So they go through 2 15-year phases. So what we're seeing now, which is my biggest concern, is we're seeing these massive exogenous shocks to the system that are setting off these dialectics, and these institutional realignments and rearrangements are extremely costly. And most people don't even comprehend what's going on here. But I think you guys need to understand that these financial crises, these political crises, and these health crises set off these dialectics and will shift these institutional arrangements that will shift your strategic investment strategies for the next 10, 20, 30, and 40 years. So we need to be, smarter. Obviously, the politics is extremely important too. The mean voter theorem and public choice theory basically lays this out. We should be making policy in the center, of the spectrum, but we were pulled so far to the right under the Trump administration that a lot of the policies were just so foreign and out from the center. Policy needs to be conducted in the center to have the biggest impact on the majority of the population and the economy. Let's see. Where I see the volatility coming in, both boom and bust from the real estate pricing standpoint, is not really the numerator or net operating income volatility, but it's the discount rate. The discount rate, particularly interest rate policy, more volatile. Credit risk premiums, more volatile. Credit spreads, more volatile. Political and policy risk premiums, more volatile. So basically now as investors and investment managers, we have to manage our portfolios and our properties and our investments in a more volatile environment, which means it's more risky. That means we have to educate ourselves more and be smarter in our strategic allocation of our capital and how we advise our clients. So there's just more systematic risk. To mitigate systematic risk, we need more unsystematic risk. So basically, it's focusing on your clients, focusing on your business, focusing on technology, hiring the best people, being extremely efficient at what you do. 80-20 rule, focus on the 80% of your clients that generate the majority of your income, and take on more unsystematic risk to mitigate the systematic risk that we're having to deal with constantly. If I was building a prototype or a target or model portfolio for the next 30 to 40 years, which I am for my students, my recommendation would be an allocation of 40%, 45% in bonds, 25% in equities, 10% in cash value life insurance through a mutual insurance company, 10% in direct public or private equity real estate, and 10% in alternative renewable energy products and assets, because those alternative assets, their returns have low, no, and negative correlation with stock bond returns, which bows out the efficient frontier. Yes, it brings down the expected return on the portfolio, but the risk of the portfolio is brought down even more, which means that the risk-adjusted rate of return goes up. And if I can get my clients a 10% rate of return annually, under the rule of 72, I can double their money in 7.2 years. That's the goal. Monetary fiscal policy, I already talked about, hyper money supply growth rates. During the pandemic, the money supply was growing at 80 to 90% last year. Never seen anything like it in the history of monetary policy. During the financial crisis, M1, M2 were growing at about 30 to 40%, and that was unprecedented. So basically, we were growing the money supply at double the rate of the highest rate during the financial crisis. So unprecedented. And I'm actually telling my students that these economic and financial textbooks that I'm teaching you from, a significant portion of those books are completely irrelevant, because a lot of the economic and finance theory were based on old paradigms, and your generation, our generation, needs to rewrite these books based on what's happened over the last 10 to 20 years. We talked about fiscal deficits, the amount of debt. At some point in time, just the amount of interest on the debt is going to start to eat into a lot of the discretionary spending, which means that they're going to go after entitlements. They're not going to go after taxes for corporations and high net worth individuals. They're going to go after taxes for the middle class. They're going to go after entitlements, and just wait. They're coming at some point in time. They're coming. And you've seen the tax legislation that has been proposed by the Biden administration. They're going after 1031 exchange. They're going after capital gains. They're going after high net individuals. They're going after estate taxes. It's basically going to be a rewrite of the tax code with higher taxes. That's going to pay for a lot of the excessive spending that's occurred over the decades, and the spending that we just occurred during COVID. And it's going to pay for the infrastructure bill, the current budget, the entitlement programs. Again, where's the money going to come from? Eventually, it's going to come from us, and particularly real estate investors, because we're the most obvious targets for taxation. Here's the Federal Reserve's balance sheet. The Federal Reserve's balance sheet was about $1 trillion prior to the financial crisis. Then it went to 2 trillion. Then it went to 4 trillion. Now it's at 8 trillion, and it's probably going to go to 9 or 10 trillion. Where's the limit, on this over accommodative monetary policy, or do we have QE forever? I don't know. We don't know, but that's the 300-pound gorilla, is what is the fiscal and monetary impact going to be on the economy in a decade or two, and who's going to get hurt and who's going to benefit. This will have to be addressed at some point in time. And when the Fed does pull back and does start to do quantitative tightening, the stock market's going to convulse, the bond market's going to convulse, and the real estate market is going to convulse. So you got to keep your eye on monetary policy. Listen to what Jerome Powell, listen to what Janet Yellen says on the Treasury side. They're in coordination. The punch bowl is brought by the Federal Reserve to the party. the punch bowl is taken away by the Federal Reserve at the end of the party, and then we have to deal with the hangover until they bring the punch bowl back. And then here's the statistics. Of the $8 trillion on the Federal Reserve's balance sheet, $5 trillion of that is US Treasury securities. So the Federal Reserve is printing money and basically financing the fiscal deficits in the debt. The second largest category is mortgage-backed securities. So we have benefited significantly through a commercial mortgage-backed credit facility that the Fed started this last round, and the mortgage-backed securities that the Federal Reserve has basically been accumulating and making a market in those securities and holding them on their balance sheet. We've been benefiting significantly in the commercial and the residential real estate markets by the Federal Reserve printing money and buying those mortgage-backed securities and keeping interest rates low. Here's the money supply growth rate. And as you can see, it's in an upward exponential trajectory. Here's the money supply growth rates. You can see they basically peaked and spiked during COVID. And you can see where the historical levels were going back to 1998. The money supply should be growing at the rate of economic growth, GDP. So we're seeing massive over accommodation, again, to keep interest rates at zero, to keep the economy going. And my concern is when the Fed starts pulling back, we'll see what happens. Here's the velocity of money. This is the number of times money circulates in the economy on an annual basis. The velocity of money is collapsed, okay? And it was already in a cyclical, secular downtrend. The velocity of money, in my view, is one of the most important components to targeting inflation and targeting GDP. The Federal Reserve can print as much money as they want, but if velocity of money does not increase in conjunction with money supply, it's not going to have an effect on inflation targeting, and it's not going to have an effect, long-term effect on GDP. So the number one factor that I found out that drives velocity of money is employment rates, wage growth, and labor participation rates. And currently we have very high underemployment and very low labor participation rates. So we need labor policy to cure the market failures. This is inflation. And as you can see, inflation's peaked and it's as high as it was in 2008 and 2011. If it continues, the Federal Reserve will eventually start to enter into the marketplace, start to sell bonds, drive down bond prices, drive up short-term interest rates, or the market itself, the bond market, which is massive, will start dumping short-term treasuries, causing bond prices to go down and interest rates to go up. And again, if the curve inverts, stock market peak in 12 months, recession in 24. Here is the yield curve. Now, the yield curve next to the stock market, as you can see, has gone straight up since 2010. No real corrections because the yield curve is extremely steep and it's shallow. Just as long as the Fed continues to pump liquidity into the system, the stock market will continue to go up. And we haven't even seen a major market correction since maybe 2019. So my biggest fear is if the Fed ever starts to pull back and the yield curve shifts up, flattens, or inverts, the stock market will go into a major correction. And that's what they're concerned about because there's massive wealth effects. People who actually own stock that have benefited significantly over the last 10 years have more money to spend, to consume, invest. And again, that creates a multiplier effect for the economy. Economic indicators, GDP, I just told you. The forecast is 7 to 8% in the second half of the year, which is really good. But there is some fear that maybe in 2022, if the Fed does pull back, we may see a double dip recession by 2024. We'll see what the Federal Reserve does. But if you look at the minutes from the Federal Reserve meetings, they've started to talk about tapering and started to talk about 2 interest rate hikes starting at the beginning of 2022. This is industrial production, totally collapsed. It looks almost like the 2008, 2009, but the recovery was a lot quicker in industrial production this time around because of the massive monetary and fiscal supports that were provided to corporations, individuals, into the economy. So that's good. Here is non-farm employment. Non-farm employment, currently, this is a percentage change. We have a long way to go to bring back the workers that have been dislocated from the massive depression that we went through at the beginning of last year. Luckily, it's positive. It started to actually slow down a little bit, but we need to be running at about 2-3%. And currently, we're still negative on a year-over-year basis. So it's going to take some time for the labor markets to correct. And they're actually correcting pretty quickly, which is extremely positive. It'll be interesting to see if it's sustainable. This is the unemployment rate. As you can see, the unemployment rate last year was the highest it had been since 1948. It peaked at 15. The underemployment rate was 30%, which is the highest it has been in post-World War II history. And the labor participation rates have collapsed. I really look at labor participation rates. And this is labor participation right there. The reason why labor participation collapsed is because of the lockdowns. And the sad part of the story is a significant portion of the people who have not re-entered the labor force are either minority people of lower class and females. We've lost 2 million females in the labor force participation over the last year. We need labor policy to bring people back into the labor force. And if you look at labor force participation, it used to be fairly high in like 2001, 2, 3. All of that delta underneath the 66%, that's lost productivity. That's lost GDP. So we need labor policy. Here is the San Francisco Bay Area. This is we lost about 400,000 jobs. As you can see, we've started to recover the job creation, but we're nowhere close to where we were right before the pandemic. So we probably have at least maybe a couple of years to be able to get back to the base, the employment base that we were at prior to the pandemic. Labor policy. Here is non-farm employment net change. So again, just collapse, nothing that we've seen. And again, it's popped up. So it's in the right direction. We could probably be positive in the second half of this year, which again bodes very well because employment is the major drivers for demand for residential and commercial space. So you need job growth. Here's employment cost index, which has also moved up, which is also inflationary. Here's hourly earnings, which is collapsed and starting to recover back. This is going to fall into real wage growth, household income, consumption on the retail side for the consumer. So we need real hourly wage growth. And actually, depending on the industry sectors, we are seeing labor shortages in certain segments of the economy, and employers are finally, after years, starting to pay premiums to bring workers back into the labor force to probably pay them what they're actually worth. So that's a positive for workers, which gives them more money to consume and invest. Here's productivity. Productivity collapsed and starting to come back, which is positive for profitability for corporations in the stock market. Import prices have increased significantly. That's also inflationary. The 10-year Treasury yield, as you can see, basically collapsed and bottomed out in 2000. And then it has starting to come back out and now is basically in a sideways pattern. I think as of today, I think it dipped below 1.3. It actually has been drifting down as the market starts to look at economic activity in the future. And I think because of the infrastructure plan has run into some objections by the Republican Party in the Senate, that Biden's now had to go back and renegotiate the $2 trillion for a $1 trillion infrastructure bill. The market is now saying that's going to be less fiscal stimulus in the economy. So we're going to downgrade our GDP forecasts for next year. If you look at consumer confidence, China's consumer confidence has recovered significantly earlier because of the lockdown and being able to quarantine and be able to control COVID outbreaks. Across the rest of the major industrialized economies, consumer confidence bottomed last year and is now starting to recover. And actually, business confidence is starting to recover even quicker. The problem is that the Delta variant of the COVID virus is now spreading rapidly, particularly through unvaccinated populations, which is leading some countries to actually start to lock down again. And that could actually be global risk to economic activity on a global basis. Retail sales were negative in April. They were actually positive in March. They continue to be positive, so that bodes well for retail sector. Economic indicators, the leading indicators, again, are pointing in a positive direction, which bodes well for the second quarter and early half of next year. Semiconductor sales is continuing to recover. And actually, the tech sector benefited the most from COVID as people went online to basically through Zoom and the increased demand for cloud computing and data centers and infrastructure and PCs and switches, and the whole tech sector has benefited significantly, which bodes well for the peninsula and bodes well for Silicon Valley, Mountain View, Sunnyvale, Palo Alto, the core markets in Silicon Valley. Venture capital hit a record in the first quarter of 2021, and the fourth quarter was the second highest ever. The second quarter of this year will probably also reach record highs as there was pent-up demand to do deals that they couldn't do during the pandemic. That bodes extremely well for the Bay Area. We, as the Bay Area, capture around 70% of quarterly fundraising for venture capital on a national basis. Unbelievable. Unbelievable. And you can see the spike right there in the first quarter. The majority of the venture capital is going into internet applications, healthcare, mobile telecommunications, and software. So if I was going to invest in real estate, what I would do is I would go find where these firms are clustering and where they're located and buy real estate in those areas where these companies are actually clustering and locating: Palo Alto, Sunnyvale, Mountain View, Cupertino, parts of San Francisco, on a sub-market basis. So there's your economic-based diversification concentration strategy. Trade deficits are actually ballooning, which is actually a good sign. Some people say they're bad. I actually think they're good, because when we're running trade deficits, we're bringing in cheap imports into the United States, which holds down inflation, and we're buying goods from other countries around on the globe, which is pulling up economic activity on a global basis, which then they buy our stuff. So this actually is a positive in my view. On the residential housing side of the market, using the Case-Shiller index, we've seen home prices on a year-over-year annualized basis reach 13%. This is the highest it's been since 2014, and it's all-time high in 2005 and 2006. The housing market is currently on fire, although it's being tapered by lack of inventory. Low interest rates, people going back to work, people deleveraging over the last year bodes well for the housing market, at least for the next 12 to 24 months. Wish we had more inventory. Obviously, a spiking in construction costs kind of limited the amount of supply response that should have occurred. And I actually believe that the federal government should cut a deal with Canada on a trade policy basis to allow us to be able to import cheap building materials from Canada and from China to be able to create some supply in the housing market and the commercial markets to basically create a supply shock, which would benefit us in the long run. If you look at home price appreciation rates, Vegas 10%, Los Angeles 13%, Phoenix 20%, San Diego 20%, Seattle 18%. Just amazing, price appreciation rates. So if you bought real estate, that was great. How am I doing on time?
I think you're good to go. Yeah.
How much more time?
Let's see. Eric, what are your thoughts for Q&A?
I'm almost done.
Keep going. I think you're fine. Yeah.
Hey, can you give me a time?
Eric, unmute yourself.
10 minutes, 5 minutes?
I think we got 15 to 20 because I have 11:40,
Oh, okay.
11:45, so even 15 minutes.
Yeah.
Okay, good.
Yep.
Okay, good. All right, so I already went over my my business cycle forecast. And again, what I learned when I was running the research department for VRA Properties for 7 years is we found out that the Class A submarkets are Class A submarkets for a reason. They have certain locational attributes that make them the best submarkets over the long run. So those markets, and some of those markets, have been significantly impaired over the last 12 to 14 months. But what happens is when the labor markets are dislocated and people lose their jobs, they move to cheaper areas in the suburbs or in the interior valley. Once the economy starts to recover and they see that they can get a job back in the core CBDs or in the core infill areas within the, let's say, the Bay Area, they're going to come in, take advantage of the lower rents, which is going to drive up physical occupancies and eventually economic occupancies, rents, and valuations at some point. So the core submarkets are really, from my perspective, is really where you want to be focusing on for your long-term investments, because they're always going to be the best markets and they're always going to be the most sensitive to basically rents. So I can always increase my physical vacancy rate by lowering my rental rates, particularly in apartments. And then eventually when the market comes back, I can get some turnover. I got some loss to lease. I can basically bump the rents. And eventually bring up the economic occupancies and bring up the valuations to then re-lever the property. Unfortunately, cap rates haven't really adjusted in particularly apartments over the last year, maybe in some markets, but not, overall, because there was just so much massive monetary and fiscal accommodation that held cap rates down. The industrial market on fire currently. Big markets like Oakland, R&D and Silicon Valley, industrial in the South Bay, industrial in the Inland Empire, seeing major, absorption trends. Their absorption never turned negative. Their rents never, fell. They just slowed or flatlined. And now with people going back to work, people going back to the mall, demand for industrial space is increased even more. You can't afford a industrial building, buy industrial REITs. Here's the vacancy rate or availability rate. You can see it dropped after the last recession, and it's basically been below its structural vacancy rate for quite some time. If the vacancy rates remain below structural, that means that rents are growing up at or above the local inflation rates. So industrial, not a problem. And then rental growth rates, you can see, in positive directions. The top markets for industrial, either by net absorption or rent growth: Dallas, Atlanta, Inland Empire, Phoenix, Chicago, Pennsylvania, Columbus, Houston, Central New Jersey, LA. On a growth rate basis, Salt Lake City, San Antonio, Reno, Las Vegas, Phoenix, Columbus, Louisville, Atlanta, Dallas, and Inland Empire. You go into those metros, you look at the submarkets, you pick the submarkets, you invest in the best submarkets. Here's the logistics vacancy rates on a global basis. Again, extremely low as the global economy adjusts to a post-pandemic recovery. Here's the logistics markets right now. Some of the top logistics markets on a global basis: San Francisco Peninsula, the North Bay, Puget Sound, San Diego, Orange County, Long Island, LA, Oakland. So what you can see is in the top, 50th percentile, has a high concentration of markets located in the Western region. The West is the best unless you want to play Russian roulette and go to Houston and go to Dallas and go to the commodity markets in the South. I'll let you guys decide. Apartments, you can see although the vacancy rates are rising, you can see that it doesn't have the rental rates here, but you can see that vacancy rates have increased, but they're still below the structural vacancy rate, which bodes well. Apartments is the best asset class in real estate because you have demographic demand, you have economic demand driven by employment, you have price elasticity in the rents, where you can lower rents and increase physical occupancy rates, and you have Fannie and Freddie Mae and Freddie Mac, the government-sponsored entities, and you have large financial institutions that compete against each other for basically mortgage lending in the apartment market. The other commercial asset classes do not have these comparative advantages that apartments do. So apartments, in my view, #1 asset class. Here is your rent changes. So it looks like the rental declines have bottomed out. And I'm hearing that rental rates in San Francisco have started to stabilize and have started to increase in some of the markets fairly aggressively. Here are the top rental growth rate markets for apartments: Inland Empire, Sacramento, Ventura. Those are Inland Empire, Sacramento commodity markets. Ventura, San Diego, supply constrained. Portland, commodity. Orange County, supply constrained. Honolulu, supply constrained. Seattle, supply constrained. Oakland, supply constrained. LA, supply constrained. San Jose, supply constrained. San Francisco, supply constrained. If you want to invest in commodity markets, you better be good at management. If you invest in supply constrained markets, yes, it's more expensive. Cap rates are lower, but again, there's less volatility. Your product is more desirable, especially if you keep it up. And again, in the long run, if you can get even inflation rate growth rates in your NOI, you're done. You win. Okay, it's the tortoise in there. I'm a tortoise. I'm not a hare. Okay, I like to win races. Some people like to chase yields. I like to chase risk-adjusted rates of return. I'll be happy with an 8% rate of return, so I can double my money every 10 years. That's all I want to do. Okay, and then here's transaction volume. So you can see it's fairly low, and that's just as of year to date 2021. This will probably come back, but again, lack of inventory and really pricing hasn't really adjusted yet in apartments, unless you go to Dallas, unless you go to Houston, you go to the commodity markets. And if you can get the pricing haircuts, that's great. But I looked at some inventory that came through from Dallas and Houston, and they were still trying to price it at pre-pandemic cap rates. These guys are totally high. Okay, at some point in time, there's going to be some kind of mark to market in some of these asset classes in these commodity markets. Office market. This is what I think is interesting. Is basically Cushman did a survey and basically surveyed occupiers, and the occupiers basically said that they would get back to 70% of their leases, right? They take out the leases. So let's say it's 100,000 square feet or 1 million square feet. They will go back and take 70,000, or 700,000 square feet of their 100,000 or 1 million by September of this year. So the majority of businesses, occupiers, are going to be reoccupying 70% of their leased space by September. And I'm thinking that it'll probably go higher by January of next year. So there could be an office play also. But sublease space is still surging as more direct space is being converted to sublease space and being dumped on the market. But the rate of change in sublease space coming on the market is starting to peak. So it's increasing at a decreasing rate. And once it starts to decrease, at an accelerating rate, that's when we know that the office market recovery is actually starting to take hold. And you can see here's the sublease space starting to taper off, which is positive side. Okay, but we're still seeing negative net absorption in these markets. And then here are some of the markets on a global basis. Again, still some negative rents, particularly in the United States. But again, this will probably bottom out through the second half of this year and into the first half of next year. And hopefully we'll see a nice office market recovery starting in 2003, 2004, unless we go into another recession. Retail market, actually, it really depends on the sector, the segmentation within the retail sector. Some of these sectors have actually fully recovered and are actually doing extremely well, particularly sporting goods, electronic and mail order, building materials, motor vehicle parts, if you can get the parts, food and beverage, furniture, general merchandise. So when you're looking at your retail centers and you're trying to figure out your tenant mix, you might want to think about, well, maybe it's a good time for me to remix my, my strip center and bring in some tenants, buy out some tenants, and reposition my property for a better retail mix. It's going to cost you money, but you're now aligning your mix with consumer demand based on preferences. Here is, as you can see, net absorption still negative, but it's starting to come up, and leasing activity is starting to improve on the retail side. The bottom pricing indicator is retail compared to all commercial. So retail is still impaired, even though it is recovering. And there's developers out there that are now looking at, and municipalities that are now looking at legacy retail centers and trying to reanimate what that retail center highest and best use could be to be able to regenerate and replace the tax base that has been lost due to the degradation, of the regional or the super regional mall product. Here is probably the markets that I would be targeting if I'm focused on retail, would be the top markets with major migration inflows, right? Because here are all these people that are flowing into Phoenix and Atlanta and Houston and Dallas and Vegas and Austin and Orlando and Tampa and Charlotte. I would go to those metro areas. I would start doing some research, figuring out the submarkets that are attracting the majority of these immigrants, and basically be making, commercial investments, in those areas that are attracting the majority of the migrants, because that's just demographic demand. Data center market is one of the hottest markets right now. Infrastructure REITs, data center REITs. Data center REITs did 22% per year over the last 5 years as a sector in the REIT market. Bay Area has a big data center market. Northern Virginia is the biggest market. If you can't buy $1 billion data center, buy some data center REITs. And then here are the major markets on a global basis. Life science, another major hot property sector. Actually, there's a lot of activity in the South Bay, particularly South San Francisco, around Genentech and around the airport, where a lot of the legacy R&D space and legacy office space that's probably fully obsolete and physically deteriorated is now basically being repurposed to a highest and best use of life science incubators or life science space and laboratories. And those are the top markets for life science. So if you believe in life science, San Francisco, San Diego, Seattle, LA, and Denver in the Western region, and Boston if you want to go there. And these are, again, the top life science markets. Real estate investment market. Here is total investment flows. So you can see it's starting to recover year to date, and the projection for investment flows into investment real estate is projected to increase throughout the rest of the year. And if interest rates continue to stay low and the economy continues to recover, I think that investment flows into investment real estate will continue for at least the next 3 to 6 years. Here are some of the volumes. Again, they're still low, but again, recovering. Here is some global investment totals. Again, it peaked out in 2000. They've come down. I think they're going to go back up again. Here are the top markets for investment flows in the United States: LA, Boston, San Francisco, New York, Dallas, Phoenix. LA, Boston, San Francisco, New York, LA, New York, massive markets, huge markets that can actually accommodate, million or billion dollars of investment transactions by institutional investors and also global investors.
This is
So there's some,
5-minute warning. We're
okay,
about to wrap up.
okay. And then here are the top markets: LA, New York, San Francisco. Submarkets in the Bay Area. Uh, Personally, based on my research, the Class A submarkets: Mountain View, Los Altos, Central San Mateo, Russian Hill, Embarcadero, Sunnyvale, Marina, Pacific Heights, South of Market, Fremont, Newark, Union City, Walnut Creek. This makes sense. I'm looking for markets that are scoring high, both on my quantitative and my qualitative survey. I'm also looking at markets that either score high quantitatively or score high on the survey scores. The ones in the bottom left could be opportunistic markets, moving in, moving out, flipping, short-term capital gains, repositioning, maybe picking submarkets that are on the border of Class A submarkets that are in the progression of basically regentrification and capital flows. That would be a strategy that I would do. So here are the core markets in red and orange. Those are always going to be the core markets. They'll always outperform in the long run if you can stomach the cap rates and the price per pound. Here's a capital flows chart. As you can see, the capital flows basically between the late 90s and up until like 2007 was in an upward channel. If you look at our current channel, it basically looks the same. So my forecast from a technical standpoint is those capital flow channels and trend will continue over the next 3 to 5 years. So again, bodes very well for real estate investment. And on the mortgage side, a lot of activity from the government-sponsored entities. Fannie Mae, Freddie Mac, HUD, major activity in buying, pooling, Wall Street securitizing. So the GSEs, are actually creating and providing a lot of the liquidity, particularly in the residential and into the apartment markets. The REIT market went through a correction, but as you can see, it's basically continued in its upward trend. REITs are great vehicles. I mean, the average rate of return on the NAREIT All Equity Index per year over the last 20 years was almost 15%. And you get liquidity. That's pretty damn good. And a lot of the property sectors that were negative last year are now positive this year. So again, if you can't buy real estate because you can't afford it, buy property sector REITs, buy individual REITs, buy ETF REITs, buy into the sectors, because at least you can participate in the commercial markets. What I think is interesting too is the CMBS spreads. The credit spreads on CMBS, you could see, got totally blown out last year, but the Federal Reserve stepped in with their CMBS credit facility, started printing money and sucking up CMBS debt and basically compressing the credit spreads, basically creating liquidity and basically allowing the commercial real estate markets and the conduits and the CMBS market to continue to function, which we benefited significantly from. And if you just look at the performance of CMBS using an exchange traded fund, it actually has done extremely well, over the last 4 or 5 years. So not a bad, asset class to also participate in real estate. And then CMBS issuance never got as high as it did in 2006 and 2007. But again, as you can see, the capital flows continue in CMBS issuance. It didn't shut down like it did in 08, 09. So again, bodes really well from a liquidity standpoint. So that's basically all I got.
All right, Dr. Souza, thank you so much for the breadth and depth of the information you shared. I felt like I was sitting back in my economics and finance classes at Cal. So thank you so much for that. Do have some questions for you. Earlier you mentioned quantitative tightening. When do you expect the Fed to start implementing that?
Yeah, they've already started talking about it. So go back and read the minutes for the Fed. So they've already talked about it, and they're already guiding the market for 2 interest rate hikes in the first 6 months of 2022.
So, what do you think the gap is from when they talk about it to when they actually implement it? I know the Fed likes to kind of hint about what they're going to do to get the markets to prepare for it. But from what you've seen, what do you think that implementation gap is?
Well, the Federal Reserve is very nice, unlike some other government agencies. They basically publish, all of their data on money supply growth rates, the money supply stock, and the balance sheet. You just start tracking that, and it's the money supply stock, the base, the balance sheet. Growth rates in the money supply are all continuing to go up. It's when you start to see significant deceleration in money supply growth rates, you start to see a flattening in the stock, you start to see the balance sheet stop growing or actually start to decline. That's when you start to get concerned. And there's going to be a lagged effect between when the Fed implements its policy and its effect on the capital markets and the economy. So you got to do some research and you got to monitor it.
Now, I think back in 2019, you mentioned earlier in your presentation about the inverted yield curve. I think back in 2019 that we had an inverted yield curve for a couple of months, and I was expecting that there was going to be a recession, maybe a mild recession taking place after.
There was. There was.
Okay. But
there was. So the yield curve was already predicting a mild recession. We didn't know COVID would kick our ass into a depression.
Okay, but do you think because of the onset of COVID and the reaction to it from the Fed sort of mitigated that?
Yeah, absolutely. I mean, the yield curve had already inverted. We were already going into a recession in probably late 2021. So the model was already there. It was already predicting a recession. It would have been probably a mild recession, but COVID kicked us into a depression, and then the fiscal and monetary policy authorities then went into action.
Okay, so the COVID-19 pandemic was certainly a black swan event. Do you foresee any black swan events that could potentially derail the economy going forward?
Yeah, a mutation in in COVID. We were now facing Delta mutation, which is hitting a lot of the emerging markets and a lot of the underdeveloped markets significantly, and some of them are having to resort to lockdowns. That's going to have a major impact on global economic activity. If the mutation actually occurs to the point where it actually breaks through the Pfizer, Moderna, Johnson & Johnson protections, then we're in major trouble.
Okay. The San Francisco Bay Area is a relatively diverse, has a diverse economy. Do you think that insulates it somewhat from any negative economic shocks going forward?
Well, you would think that when we fell into a depression recession last year, if it was anything like the 2001 through 3 recession, which was a tech recession, it was pretty significant. Luckily for us, the pandemic basically shifted business investment and individual consumption over to technology goods, which basically benefited the whole tech sector. So we benefited significantly from the pandemic. Luckily we were. But we're still, highly concentrated to the tech sector. And if anything happens to the tech sector, we're going to go with it.
All right. Got a couple of questions from Michael Passetti. First question is, does the Bay Area commercial real estate market have influence on the Honolulu commercial real estate market or vice versa?
I don't think Honolulu would have an impact on San Francisco, but there could be an effect that well, again, is it, foreign Asian investors going, through Honolulu to get to the San Francisco Bay Area? Or has basically Honolulu been picked over so they come to the Bay Area? Or has the Bay Area been picked over so they go to Honolulu? The markets in Hawaii are supply constrained, right?
Yes.
So, and what is the economic base, and what is the demographic base, of Hawaii? It's basically tourism.
Got it.
So you really need to have some kind of diversified economic base or create a comparative advantage on a global basis to basically create under other industry sectors that would be able to drive economic growth and demand for real estate space in that economy. And that's really going to be economic development policy by local municipalities or state governments are going to need to do that.
Okay.
If they're smart enough to do it.
You started your presentation with a picture of Mavericks, right? And you had mentioned that you had surfed it. So same attendee, Michael, is asking if you've ever rode big wave in Waimea Bay on the North Shore of Oahu.
Now, I did most of my big wave surfing at Ocean Beach in San Francisco, which is extremely dangerous. I don't recommend it. And then I mainly surfed some really big waves at Steamer Lane in Santa Cruz and at Pillar at Pleasure Point were the three. So Ocean Beach, Steamer Lane, and Pleasure Point, but mainly Steamer Lane and Ocean Beach.
Okay. You actually touched on a couple of slides on labor participation and how it's impacted or it's higher in minority communities.
Yeah, participation rates are lower in minority communities.
Okay. What incentives can be offered? What type of policy to encourage reentry by the labor force?
Education, healthcare, and housing.
Okay.
It's a public good provision. It's basically poverty. So addressing poverty, you address it. If you use, the European social welfare models, it's basically healthcare, housing, and education. And education's the key. So providing free education at the city college level and retooling the educational offerings for trades and really focusing on the areas where there are basically massive openings currently and a industry education mismatch. That's what you do. You create education policies, training policies to basically target those skill sets for individuals to be able to get placed into jobs where there's labor shortages.
Got it. You mentioned, we're certainly creating a lot of national debt. Who's buying it?
The Federal Reserve. And the
okay, but no foreign investors.
Yeah, foreign investors own a significant portion of the U.S. government debt. So obviously the Saudis own a lot, the Europeans own a lot, the Japanese own a lot, and the Chinese own a lot. What a lot of them are trying to do, not only because they're receiving dollars, right? Because we buy oil, we buy chips, we buy components, we buy a lot of goods overseas. So we're trading basically dollars for foreign currency. Well, if we're trading dollars for foreign currency, foreign currencies could start to appreciate significantly, okay? And they don't want to do that. What they want to do is to recycle those dollars into US dollars, into US treasuries, okay? Because what they want to do is drive up the dollar, drive down their currency values, because the majority of those economies are export oriented. So the majority of their economic growth comes from exports. And if their currencies become too appreciated, then their exports become too expensive. So what they're trying to do is to push up the dollar, push down their currencies and keep their goods cheap on a global trade basis to allow them to continue to export out of their economic recessions.
Okay, thanks for that. I do have another question from the audience. As the boomer generation retires and dies off, do you think that will have a significant negative effect on both residential and commercial real estate moving forward?
The boomers, which I haven't been called a boomer yet by any of my students, I'd probably scream at them because I hear that's that's a swear word now. But I mean, we have what another 20, 30 years to go. A lot of these people will probably age in place if they can. There are some movements. I'm working on a product right now to basically try to get at the equity that has been built up in their homes to allow them to be able to use that equity. It's not a reverse mortgage as a cash flow, and to be able to use to liquefy the equity so that they can, if they want, bring in people to live with them or to help them as they age in place. The next generation is dying to buy homes, but they can't because they're strapped with $80,000 to $180,000 worth of student debt. So it becomes really hard to buy a house when you're straddled with all that debt. But they want home participations. They want to buy homes if they could. That's why I think actually a student loan forgiveness could be a major benefit to the housing market, because now you've just created the second and third generation of home buyers.
Okay. Last question. If you had $10 million to invest,
10?
10, right?
10.
You open it up. What would you buy? Where would you buy, and why?
10 million.
Oh, okay, 20 million. I'll up your. I'll give you more dry powder there.
Okay, thanks.
Yeah, a little more spending.
If I would probably take some of the money and invest in a diversified portfolio of REITs and taking advantage of life science, data centers, apartments, and industrial currently. And if I wanted to take some of the money and be a little bit more optimistic, I'd allocate some to retail and office. So I would have a REIT portfolio for liquidity and the ability to adjust my portfolio fairly quickly. If I had 20 million, I would probably go into. I'll go into a couple markets. I do like San Diego because they have a huge education base. They have a military presence. They have aerospace. They've done a very nice job of repositioning, and I would probably be in apartments down there. I would probably be in industrial in Inland Empire or the South Bay in LA. I would probably be in R&D in Silicon Valley, although that would be expensive. I might be a little opportunistic and go into San Francisco now because I think that the office market is probably bottoming out. And I know that some investors are picking up some office buildings off the bottom. So that would be more of a contrarian, opportunistic view. I do like the North Bay, even though I live up here now. I do like Napa. As a market, it's very thin, but it has a lot of good attributes. If I was going to go to Sacramento, I'd go to Davis and try to get as close to the university as possible. I do the same thing in Salt Lake City in Utah. I would probably be as close as possible to the medical center in the University of Utah. If I was going to go there, I'd probably be in Scottsdale, in Phoenix. If I don't know, maybe Henderson if I had to go to Vegas. I'd probably be on the west side in San Antonio if I went there. I'd probably be North Dallas in Plano or in the north side towards the airport up there, probably in R&D. If I was going to go into Texas, I'd probably be in Fort Lauderdale, Boca, Coca. If I was going to go into Florida, I would probably be in DC, to Northern Virginia in particular. I would be in Cambridge. If I went to Boston, I would be on the north side. If I went to Chicago, and then obviously I would be in Manhattan if I could get into New York, and I'd probably go into downtown.
Wow. Okay.
Good amount of choices.
That was very comprehensive.
It's great.
Thank you so much for answering questions from the floor. With that, Q&A is concluded. Justin, I give the floor back to you.
For sure. Once again, Eric Relos, thank you so much for being the moderator. Dr. Souza, thank you so much for your time and insight. So to all our attendees, to conclude this event, we'll go ahead and send out that PDF. I know it was a lot to kind of take in, so we'll go ahead and send that PDF along with Dr. Souza's contact information for any other follow-ups you might have. And around the corner in regards to ARIA events, late July, I mean, I know it's already July right now, but we're aiming for late July, give and take July 28th. Speaking about out-of-state investments, we're going to have an investor panel featuring 4 panelists with experience about out of states, out of California investments you could look at. Be on the lookout for that Zoom webinar in August as we open up the second half of this year. Our golf committee has been working very hard for our very first annual golf tournament. It's going to be in Ruby Hill, August 2nd in Pleasanton. I think there's about 20 tickets left or so. So please look into that and sign up. And last but not least, as of yesterday, ARIA National just released registration for our ARIA National Convention, which will be in San Francisco this year. Last year, we had a virtual national convention. So I'm sure that you guys are dying to see each other and network. So that will be from from October 7th to October 9th in San Francisco. Outside of that, Eric, Dr. Souza, any other closing remarks, anything else?
No exam today, and everybody gets an A.
Dr. Souza, thank you so much for your time, and thank you to all the attendees, and of course, Justin, thank you.
All right, guys. All right, take care. Have a great afternoon. Take care.
Thank you. Always great to work with you.
All right.